Hello, traders. This is Blake Morrow with Traders Summit. And with me today, I have a very special guest. I have Danielle Dimartino Booth. She is the founder and chief strategist at Quill Intelligence. Good to see you. I haven't seen you in so long. Good to have you here.
It's been a really long time. And thank heavens the world has calmed down and we can just talk about the weather. Nothing's happened in the market since we've seen each other. Yay.
Yeah. Just a few things have changed. And actually,
Not the Fed funds rate.
Well, I'm sorry?
Not the Fed funds rate.
That's right. Well, now let's, I guess we're just going to jump head first into it. What's really obviously changed between the last couple of years, the last time we met, is the rate of inflation. So, with inflation here at 8% via CPI and the Fed funds rate, last time we were here, the Fed funds rate was at 14%. And so what do you think about that right now?
Well, no, wait, last time the Fed funds rate was not at 14%. No. But you're saying last time inflation was where it was.
Yes. I'm sorry.
Yes. No, I just want to clarify because I'm sitting there trying to envision 14%. And I'm like, Volcker's alive again. Life is good. We're breaking the back of inflation. There's a real man at the Fed. I said that out loud.
You did say that out loud, by the way.
There's a difference between where we are then and now, but there's an even bigger distinction to be made. And this is, as we speak, Belarus has joined the Russians, the Russian army. They're going to be crossing that border. And the reason I bring that up is because when we think about the OPEC shock of the 1970s, we always contextualize that as being a pure play energy shock. And that ripple through the economy and the long lines at gas stations. But right now, what we have is everything that's excluded from the core, the two main components that are excluded from the core. The country has never experienced a food and energy shock together. Russia and Ukraine supply 33% of the world's grains. There's nothing you can do about a country's infrastructure that's being decimated by war when it is the breadbasket of the world. So we're not just going to have an energy shock. It's not just going to be that we're going to go from an 8% headline print, 7.9% headline print on CPI in February to double digits. It's that there might be more persistence, even if energy prices start to come down and other sources outside of Russia are secured and we come out of winter, et cetera. The food shock is double the energy shock. And I don't think there's an appreciation for that because there's no precedent.
So do you think because of that, it's going to be more affecting Europe versus North America? And how's that going to work?
I do think that it will certainly push Europe into recession more quickly than the United States in that sense. And it's interesting to hear Christine Lagarde at the podium, and she honestly sounds like somebody's plugged her in, and that if she says anything off script, that they were going to, like a shock collar was somewhere underneath her high collar. Because she stated, inflation will go back to 2%. People don't, Europe's going to go into recession twice before getting interest rates out of negative territory. They have to rewrite economic textbooks. That just doesn't happen this way. And yet here we are. So, but there will be ripple effects in the sense that everything is globalized. And we're learning right now lessons about we used to look at globalization like a Harvard case study.
Yeah.
And we used to study it, very objectively. And here are all the dots on the map and everything works perfectly. You draw lines from here to there and, the grains here feed the livestock here. It doesn't work like that. A lot of the corn that we produce, for example, in the United States is made just for ethanol, to use but one example.
Yeah.
There might be repurposing, but you can't repurpose quickly, right? Not in the current, season, so to speak.
Right.
So, yes, will it hurt Europe more? Yes. Have energy prices hurt Europe more? Absolutely. But that being said, we still have to be a net importer until we can refine what we pull out of the ground. We've killed the pipeline efforts, and we can't refine what shale produces. So it's still going to affect us.
So and then I guess you could throw the shipping issues that we have globally. It's like half the products go from the US to China back to US, or even from all around the world. It's going back and forth before it even has the end product. Correct?
It does, but I mean, the media moves on. That's what the media does. And the fact is, the congestion at the ports has largely been allayed. And the reason that Quill has been calling for an industrial recession is because we have seen inventories rebuild. And in fact, from what we can glean, purchasing managers have been very grabby and extremely paranoid. They're like, all that just-in-time stuff I grew up on is out the door. I've officially moved to just in case. So you could come to a situation in the United States in our industrial complex where you've got stockpiles of goods and we forget that it costs money to carry inventory. At the same time, margins are being squeezed because your end user can't buy your product in the face of rising inflation for essentials. And all of a sudden we could be talking about an inventory glut in the United States while it's difficult for truckers to fill up their gas tanks because diesel fuel costs so much. So it's a brain twister. But all I'm saying is, I think if we were to fast forward 12 months, we're no longer talking about the inability to source supplies.
Wow. Well, going back to, let me just really quick, just touch on inflation again. Like, how, in your view, Danielle, how is the Fed going to actually tame inflation, like, moving forward?
So I think I'm writing my Saturday piece right now, and what I'm trying to tell traders and investors that what they don't grasp is different between then and now is that the Fed does not have the choice of saying, okay, there's disruption in the markets. It looks like the economy's slowing. We're going to go ahead and lower interest rates, and we're going to go ahead and launch QE2, or we're going to ditch the idea of tightening policy. We're going to ditch the idea of shrinking the balance sheet, and we're just going to jump back into the markets and continue to go, as has been the case since Alan Greenspan was in office as of August the 12th, 1987. And traders have been, this is the only way they think, is that the Fed's going to come to the rescue.
Right.
Well, the Fed has not faced inflation like this, and they can't. They have to trudge forward. They have to move forward with tightening, and they will probably do so until something breaks in credit. So what people don't understand is that the strike price of the Fed put has changed. And the Fed's going to trudge forward because they have to.
Yeah.
We're in an election year. Democrats and Republicans are screaming about inflation that's just getting worse. And the political pressure on the Fed to continue tightening after March 16th is going to be tremendous.
So in your path of hikes, this wasn't even something I was thinking about asking until, having this conversation with you. What does it look like for the Fed, in 2022 moving forward? I mean, they're going to obviously hike next week, and next week is obviously a very historic Fed meeting, one of the most historic ones we've had in a long time. So how's that going to look moving into 2002 in your view?
Well, it's interesting you asked that, because the difference between the 2-year Treasury curve, Treasury yield, and the 10-year Treasury yield is 25 basis points. So you're asking me to tell you what the path looks forward after the Fed purposely puts the economy into recession. I mean, it's kind of a difficult question if you think about it.
Yeah.
So, because when the last time the yield curve was inverted, the Fed launched not QE, because that was the solution to an inverted yield curve. Well, we'll just manipulate rates where we can by growing the balance sheet. And now they're about to invert the yield curve in the process of shrinking the balance sheet. So traders are going to be like, you're going the wrong way. Stop. But I would argue that the Fed is going to allow sacrifice to be had in the stock market, and that the Fed could move forward with further rate hikes. They've said that they're focusing on the balance sheet. It was just a few days ago that there was the last purchase. We got up to this 8.9 trillion mark and stopped. And a good portion of the paper on the Fed's balance sheet is front loaded with 2022 and 2023 maturities. So the question becomes then one of, how much of that are they going to let run off?
Yeah.
And as they let it run off, that means that low maturity yields continue to come up and the yield curve inverts more. And then that's why traders have started to say, well, the Fed needs to sell long maturity bonds. Well, that ain't happened unless they're twisting on purpose. And
Wow.
we're not in a twist environment.
So I want to ask you another question. Gosh, there's a lot to chew on here, Danielle. But a lot of people have been throwing around the S word, the stagflation word. What are your thoughts on stagflation into this year?
So, we're coming towards the end of the period when nowcasts have gotten their kind of final bits and pieces of analysis. So the Atlanta Fed GDP is around 0.5% growth for Q1. Ben Herzon, who used to be with Macroeconomic Advisors, who's got the best GDP model on the street, he was acquired by IHS Markit, but his model is south of 1%. I think it's 0.9%. But those two Q1 estimates have effectively come down to rounding errors. And this is prior to us seeing March retail sales data. And March retail sales data is going to be the first data that reflects fully the post-Russian invasion. And the food at home costs in February, not March, February rose by 8.6%. Food at home costs.
Yeah.
Gasoline prices rose 38% in February. So we're going to see the backside of discretionary spending coming off and kind of crash into Q1 GDP estimates. And and a monkey could see that in going out over the horizon right now, that the effect that these things have. We've just had individuals' views of their personal finances from the University of Michigan drop to the lowest level since 1940. So, there's that. So there are signposts that tell you that the GDP of the United States has turned negative while the inflation has gone double digit. And it's not just that's not even the definition. All you would need is a little bit negative on GDP and a little bit positive on inflation, but we have the difference between the two is quite extraordinary. So, stagflation is a past tense discussion we're having.
Yeah. Okay. So it's like stagflation with double asterisks next to it.
Exactly.
Wow. All right. Well, that's obviously something that everybody's going to be thinking about as we go into this year, the remainder of this year. But you touched on something that a little bit earlier about the markets and about the Fed and about what they're going to be tackling, and they're going to be raising rates. They're going to be forced to raise rates. And it's going to have a consequence on the markets, on the stock market. And I guess the question I wanted to ask you is, being it is an election year, is the Fed more politicized at this point? Because, we have, inflation was at 2%, rates are at 0, inflation's now higher, rates are still 0. So, why hasn't the Fed moved at this point? And, they're trying to figure out which battle they're going to fight. But do you believe that the Fed is politicized at this point?
Well, I believe the Fed was politicized from the day that Alan Greenspan bailed out the stock market in October 1987. And I think that it's become increasingly politicized. I would argue the opposite is going to happen right now because Jay Powell is not technically chair. This is going to be the second press conference in a row that we don't technically have a chair because he left office February the 5th. And we knew that he wasn't going to be voted on at the last press conference. So I think that the Fed is going to use the cover of the midterms to say, because inflation's so high, we're going to stay the path. And that, I think, is the unexpected. Because if they were to react to a large decline in the stock market and come riding to the rescue with QE, good God, can you imagine? We already know the Republicans are going to sweep. But if the Fed was to come in and try and rescue the markets, the GOP could go out on the stump and say, we really need to stop this madness. Look at what they're doing to try and keep AOC in control. Good God. And so I think the Fed has the opportunity to do what it hasn't done in years. Because when the pandemic hit, it rescued all of the zombie companies. And in turn, we went from 14% zombies to 20% zombies. And the Fed wasn't able to let the bad credits go. I would argue that this time around, the Fed has the shield of being politicized to hide behind and say, we're just going to attack inflation for the better of the greater good of the United States population.
Wow. Well,
meaning we're going to sacrifice investors and let the zombies go and let a few of the insolvent companies go away. And it's kind of a brilliant, if Jay Powell's that man.
And do you think he's that man?
Well, Senator Shelby asked him point blank. So it wasn't original. He was like, "Are you Paul Volcker?" And his answer was, "I certainly hope that's the way I'm remembered." So if he wants to go all Paul, and we don't appreciate that the big banks don't have the Fed by the short hairs like they did in 2018, 2019, because the Fed has the standing repo facility, the Fed has the reverse repo facility, the Fed has different tools in its toolbox to control that overnight repo rate so that it's not like complete Armageddon in the overnight funding markets. So the Fed has these tools that it can let the stock market go down and not have the transmission mechanism flow through into the risk-free asset. So we'll see if they thereby, and we're watching credit spreads widen, and this could just be the beginning of the show. As my good friend from our days at the Fed, Zoltan Pozar, wrote earlier this week, if you have not read Bretton Woods 3, drop everything you're doing, read Bretton Woods 3 immediately. The most important thing Zoltan's ever written, and Zoltan's pretty important, but we're seeing in the funding markets that commodities are the new collateral, and we don't know how this is going to work out with contracts, especially when you freeze, Russia's reserves. So there are rumblings in the funding markets as well. The credit markets are starting to get nervous, and we're seeing that in spreads. And yet the Fed has a way to control the risk-free asset and overnight trading. So there's the chance that he can let credit go and that he can let some of these hedge funds blow up and not have to come to the rescue.
Well, I guess we better be keeping our eye on some of the financial institutions and some of their names, right?
Well, it all depends on that exposure, doesn't it?
It does. It does. So, Danielle, I tell you, I love what you do. I love everything that you're all about, and especially Quill Intelligence. Can you tell us as traders, just learning about you, how do I follow what your work and what you do?
So come on to quillintelligence.com and reach out to Andrew Sinclair if you want a free 2-week trial. He'll be happy to put you on one. But we're in the who cares we care business, and so we get deep in the weeds with macroeconomic research, and people are like, well, who cares? And I'm like, well, this is going to be how this dot connects to this dot connects to your portfolio. Yeah, and that's what we're all about. We do it every single day, and we translate Fed speak constantly. I did a weekly called The Game of Drones, when there was this massive fight between Lael Brainerd and Jay Powell to get named the next chair. And I speak inside baseball. I know what's going on inside the Fed. And so there's that different and unique perspective. So come to quillintelligence.com. There's even a private Twitter feed. And if you don't follow me on my big Twitter feed, that's at Dimartino Booth.
All right. Well, Danielle, thank you so much for spending your time with us. Remember, if you like what Danielle has told you today, make sure you give her a big thumbs up. If you're watching us on YouTube, subscribe to our channel down below so you don't miss any of our content. And Danielle, I know I'm going to be speaking with you in about a month's time at our annual event. So thanks for joining us today, and have a great remainder of your weekend.
Thank you. Take care. Good to visit again.
All right. Bye-bye.
Bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.